TheoTrade. This is Don Kaufman. It's March 24th, 2023. 30 minutes left inside of this trading week. SPOOs are higher at this point in the trading session. And wow, after everything that we've been through this week, the S&Ps are marginally, just marginally higher on the week. Of course, the topic of conversation of this weekend's update here at TheoTrade: what sector shall be pummeled next? Clearly, I have been trying to get ahead of some of the sectors that are seeing, well, rotations. And that in this particular case, we can talk a little bit about financials. We can talk about energy sector. We're going to look a little bit at tech. But I'm going to tell you right now, right off the bat, yeah, I am definitely taking some positions right here, right now, which I will cover momentarily. All right, to kind of give you a brief update on the week. Well, what happened this week? Well, the Fed hikes, and as I say, Yellen pikes. What does that mean? Well, let's actually take a look at the 30-day 1 hour inside of the S&P futures. And it speaks volumes over here, because when we start discussing price action in the marketplace, I mean, what is there to discuss? Since roughly speaking, and again, this is a 30-day 1 hour, since roughly speaking, March 1st, we've basically just ebbed and flowed up and down. Where are we right now? Absolutely nowhere. I mean, this is where you just want to scream. We are massively unchanged. I am a little disappointed, however, in today's trade, because we didn't hit the oh so important 39.31. Believe me, that's going to make an appearance again in the very near future. 39.31, okay, in the S&P futures is an absolutely instrumental and critical level. Right now, where are we? 4,000 on the button. But look, if it feels like really, kind of lax out there, it is. I mean, things really kind of calm down. You can see volatility coming off here a little bit, which we're going to discuss volatility in just a moment. Nevertheless, okay, there's just not a lot of commitment, if you will, to trade at these particular levels. Some of the volume kind of died down as we just, grinding listlessly to the upside over here after, well, a week that I think a lot of traders are just exhausted at this point. One of the things, though, that I'm up against and I'm having a tough time with is when you trade the exact same range day in and day out. Where are we? 39.31, 4,000, 4,040, 39.31. You trade in the same range for, now we're what, 5 weeks. It doesn't just get old. It gets very difficult continuing to allocate capital. Because whatever you did in the S&Ps back here, and now we're all the way back, if you will, into February, it's the exact same thing as here. Like if you were to actually look at a standard distribution curve here, all we're doing is just packing more risk in the exact same deviation. And when we do make that wild and woolly move to the upside or wild and woolly move to the downside, you can get torn apart. So you got to be very constrained with allocations at a time like this. All right, so there's nothing more to say on the front of the Fed, right? They hiked. That was it. Other than Jerome Powell, he's like, I have no idea what happened with Silicon Valley Bank. I appreciated that one. Then, of course, we had Yellen basically saying, we're not going to back all the deposits. Then comes back and says, yes, no, we're going to back all the deposits. So, I retort. Anyway, that's enough of it, because the media has beaten it to death. And I got to tell you, the price action, it's already played out. Look, in today's marketplace, pay less attention to what you hear. Pay more attention to price action. And right now, to me, the price action, it's not so much in the S&Ps, but it speaks volumes. I'm going to show you just that. Now, before I get more into that price action, when I say it speaks volumes, okay, let me actually bounce over to what I term like risk on, risk off asset classes. One thing that really kind of resonates with me, right? And I look at the SPX all the time, and the mother of all products. And here's kind of the week at large. So we started this week right here. And by the way, here, where I just kind of highlighted on the screen, amounts to just above 3,900. And right now we're trading, 3,970. It's a very mild rally right now on the week. And we're off the highs of the week. We actually tagged the upper edge of the expected move. Push all of it aside for just a moment. What doesn't seem to be subsiding, and I am bothered by this, and I talked about it on Wednesday night's video, and I'm going to talk about it again today. If you look at bonds, they really do, to me, and again, purely opinion, they look aligned to just explode higher, right? They look aligned to explode higher. Does it have to happen that way? Absolutely not. But I don't feel like that warm and fuzzy feeling, okay, in terms of trade when you have an asset class that right now, if people are going to pile into bonds and they're going to explode higher, to me, that ultimately says, markets are going to get pummeled at that point, right? The entire market's going to get pummeled if the bonds continue to break the upside, right? And then you look at, notes, and notes have actually already broken out. Again, doesn't exactly leave me warm and fuzzy. Okay, but that's just bonds and notes. Then I start taking a look at gold. Now, I see gold has come off here just mildly today. Of course, gold has come off mildly. Look at the move higher in dollar. So dollar's incredibly strong. Gold's coming off, but it's very negligible. And if you're not looking at gold like you look at the bond chart, look at the gold, they look like the exact same chart. Okay, so now we have this other asset class that looks like it's just going to rip higher. In a moment, I'll talk about a trade that I did in gold, bullish trade that I did in gold, because again, gold just looks like it's going to rip higher. Again, doesn't exactly leave me warm and fuzzy. So I talked a little bit about bonds, okay? The bond chart, the gold chart, they look almost identical. Again, for risk on, risk off asset classes, this basically means risk off, meaning that if gold continues higher, kind of means risk off, the S&Ps get pummeled, yada, 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 that's great. Okay, same thing with the bond market. If bonds continue higher, I would believe that would be very negative for the S&Ps. All right, last but not least on that front, volatility. Now, again, whenever I bring up volatility, everybody goes, I'm going to look at the VIX. Well, interestingly enough, you can look at the VIX if you want. Like, all right, let's do it. Okay, the VIX is kind of mellowed out at the 22 level. But today, you have the S&Ps up 20 handles. Like the S&Ps are, taking off to the upside here. VIX is not coming off. VIX clearly sees something, but I don't look that much at VIX. I look at like vol futures. And one of the things I look at in vol futures, I don't even justify where they're trading. I don't care. Like, people go, what do you mean you don't care? No, I really don't care where they're trading. What I look at is, contango and backwardation. And we're still incredibly, incredibly tight. And that is between the Aprils, the apes, okay, and the Mays. So, the Aprils are trading at 23.60. Okay, and the Mays are at 24.20. It's still a hop, skip, and a jump away. It's not exactly sounding the all clear. And again, what I'm looking at here and kind of justifying by looking at the volatility futures is, as I said, it's what we call contango and backwardation. And what it ultimately means when April is very, very close to the price of May, okay, it says that risk right now, okay, is not abating like people think it is, even though the S&Ps are up. And, that's something that should be construed as a warning shot. Now, VVIX, that's the volatility index, it's come down a bit, but I warn you here as well. After the Fed, it dropped, okay? There's no question it dropped. And, okay, where does it sit now? At 100, actually bid up a little bit and faded again, but it looks a lot like the other volatility products. What I'm basically going to just summarize into is a very, very simple idea. Volatility is not necessarily subsiding all that much. The bonds look like they're ready to break out. Gold looks like it's ready to break out. Okay, stop sounding the all clear on the fact that we actually have a small bid under the marketplace. That's it. Okay, now we're going to switch gears entirely. Okay, and the reason I want to switch gears is, as I was saying, to kind of kick this off, the topic of conversation of this weekend's update is what sector shall be pummeled next? So what sector has been pummeled? Well, if you take a look, obviously, at the financials, not only did the financials get pummeled, they actually broke into new lows today. They're hanging on to 31 like it's grim death. If you look at the energy sector got pummeled. It too hit its lows and hanging on to 77, 78 like it's grim death over here. So what's next? Now, I'm just going to throw this out for you right now. Okay, what sector shall be pummeled next? Oh, I'm looking at tech. You go, well, but what? I'm looking at tech. Look, there's only 3 sectors that even matter anymore in this marketplace. You got financials, you got the energy sector, you got tech. And you go, but I love Costco and I love Walmart. And what about Caterpillar and Boeing? Oh my. None of it matters. It's all for nothing. It doesn't matter. And I'm going to show you that right now. Because in the S&P 500, ladies and gentlemen, we have the most concentrated equity risk in the history of the markets. And that's something that everybody is missing. And if you're kind of sitting at home and kind of playing the TheoTrade at home game, you'll notice as of late, I've been all about the financials. Okay. I was looking for the financials to break since the beginning of the year. They broke. Okay. I was looking for the energy sector to break for a significant period of time. By the way, I don't speak with the mouth. I'll trade it. I'm short 700 shares in the energy sector. I'm short some ExxonMobil. I'm short all kinds of XLF. I'm short some JP Morgan. I'm short Wells Fargo. Okay. It's a party, people. All right. I'm long a little bit of hood. I'm willing to admit it. But again, I like to show the positions because right now, what am I doing? Now I'm rotating. Now I'm actually starting to short tech, and I'm going to explain why here momentarily. Look, okay. If you take a gander, if you will, at the XLE, it's down about 7.5% year-to-date basis. If you look at the XLF, okay, the financials, they're down almost 10%. Taking a look at, let's look at the Nasdaq, the Qs themselves, they're up almost 17%. If the S&P 500 is going to take a hit, I'm just going to say this right now, if the S&P 500 is going to take a hit, unequivocally, it has to come from the Nasdaq, okay? The S&P 500 cannot get out of the 4,000 range without the Nasdaq taking a hit. Today, we're starting to see some evidence possibly of just that. Look at stocks like NVIDIA. NVIDIA, all right, little sell side activity. You getting nervous yet? Probably not, okay? Hey, you're going to point out META. That thing is still running. It's a running. This is one of the stocks I actually happen to short as well. Okay, creating a couple of short positions inside of META, including, of course, short stock, have some put spreads in there. It's a party. Okay, but I'm starting to shift my short positions into tech, less about the financials, much more into tech. Why? The most concentrated equity risk, in the history of the S&P 500. Let me elaborate for a moment by showing this. What is this? And I'm going to kind of highlight it and explain it for just a second. Okay. This actually is brought to you by, this is a company called Slick Charts. It's just a little website. It has nothing more than like this on there. It's analysis, okay, of S&P 500 companies. But this has to do with weighting, okay, versus the number of companies. What I'm showing you down below over here, there are 12 firms that now equal, okay, just greater than 30% of the weight of the S&P 500. By the way, of those 12 firms, you're going to love this. Google is counted twice. So technically, you have 11 companies, okay, that are greater than 30% of the entire S&P 500. And it's so inordinately weighted into Apple and Microsoft, Amazon. By the way, NVIDIA is one of the biggest monkeys on the block. Yeah, you didn't know that. Actually, Google is still technically bigger, but NVIDIA is up there. It's like a $650 billion behemoth. So what's the cause for concern over here? Look, the S&Ps, they can't move at this point without sector rotation. Moreover, if you want to take a look, this is the Nasdaq. The Nasdaq, it's the same usual suspects in here, but if you take a look at the Nasdaq, the top 11 companies in the Nasdaq are good for 57% of the Nasdaq 100. By the way, out of the top 11 companies, the reason I picked 11 over here, Google is counted twice over there. So the top 10 stocks, okay, are almost 60% of the entire Nasdaq 100. We got problems, people. We got significant problems, okay? So why? Why do we even have to rotate out of tech? Well, do you think stocks like META are going to be immune? You can give me fundamental reasons here, left and right. Look, they did job cuts and so forth. Okay, the S&P 500 recognizes in most respects we're probably going into a recession. There'll be some interest rate cuts, but first thing you're going to do is they're going to go after advertising dollars. If you haven't looked at like a company profile and something like META, 92% of META is advertising. Okay, so META is already getting ahead of this. META is actually slashing jobs left and right. and that's actually causing a bit of a rally. Nevertheless, I want to be in the short meta business right now and in a big way. And it's largely predicated on the idea, look, okay, this is going to be a sector rotation. And if you're looking at the marketplace literally today, you'll notice all of a sudden the Nasdaq's been the strongest suitor out there. How come the Nasdaq is weak relative? It's actually tipping its hat that what sector shall be pummeled next? Likely the Nasdaq. Again, the Nasdaq is dramatically outperforming, and I believe that that disconnect, okay, is going to be snapped. I mean, there's a huge divergence where Nasdaq is flying up, and clearly the Nasdaq got pummeled last year, but the outperformance must come to an end. What we've basically had is we've had bank stocks down, we've had energy stocks down, we've had tech straight up. Okay, we're going to see a little bit of counter rotation, and I think that's going to actually happen literally this next week of trade. In fact, it's already going on here a little bit today. Again, you got the SPX up 20 handles, and you got stocks like Amazon, which are in that top 10, not getting out of its own way. Google, massively unchanged. Okay, Nvidia has been down throughout the course of the day. Tesla's even, failing to move. So there's a degree and an element of weakness. By the way, I love the reason for piling into Meta. If they ban TikTok, okay, people are going to go into Facebook. Really? Because talk to anybody under the age of 20 years old, they don't even know what a Facebook happens to be. Just throwing that out there for your consumption. All right. So that's why I wanted to talk tech. That's it. I mean, that's the next sector to get pummeled. And yeah, I am pointing fingers at Meta. And yeah, I did create short positions, which brings me to my next point. Get your trade on. Get your trade on this week's profits and losses. The only thing I really wanted to cover with Get Your Trade On happened to be I shorted calls right at the highs. It's golden. Okay, why did I short calls at the highs? There's actually a lesson in here, and it wasn't that Don is right. It has nothing to do with that. The lesson actually out of this one of shorting calls at the highs had everything to do with the fact that I always talk about the upper and lower edge of the expected move. And you see right here, okay, by the way, this is where the week started, okay, and that's right down at about 39.15. And this upper, okay, is the upper edge of expected move. And I always say, people say, when do you allocate? I allocate right at that upper edge of the expected move, okay, and I hit it. And literally, we hit the upper edge of the expected move. All right, I'm going to zoom into this one because you guys kind of appreciate it. We hit the upper edge of the expected move at 11:48. At 11:52, okay, I sold calls. Where did I sell calls? Oh, right here. Those are the calls I actually sold, and you can see I sold a 10 lot of out of the money calls right at 11:52 was the fill. It's not about good. It's about just, hey, look. It's the upper edge of the expected move. We sell calls at that point. Today, I actually opened up two different trades. I opened up a short position inside of Meta using an in-out spread, one strike in the money, one strike out of the money. All right, so it's bearish position inside of Meta. I then turned around and actually opened up a bullish position inside of gold. That one's 35 days out. Why a bullish position in gold? Why not? Look at the size in there. Over 3,000 contracts. That's us here at TheoTrade. All right, with that, that's some of the trades. I wanted to talk about forward-looking trades. I'm not even talking about so much about, okay, I got the SPY calls on at a good time over there when it's highs in the market, but I want to be very forward-looking, and I'll talk much more about gold and Meta this coming week, of course, live on TheoTrade throughout the course of the week. Last but definitely not least, I love to cover the SPX and the weekly expected moves. And the reason I'm covering the expected moves over here is simply because when we hit the upper or lower edge of the expected move, is when opportunity comes into play. This week that we just went through, our expected move was plus or minus $120. $120 a movement. We tagged it almost to the penny and reversed off of it, on both Jerome Powell and Janet Yellen comments. Meanwhile, we're listlessly higher on the week. What are we looking at for next week? I mean, come on. Next week can't possibly be as wild, but we're still looking at about a $94 implied movement. It's still, do not again crawl under the desk over here and hide just yet. So the expected move drop, but it should. You don't have, again, the Janet Yellen, you don't have as much, if you will, as headlines of banking crisis. But I'm going to tell you right now, you keep your eye on big tech. Pressure is forthcoming in here. Clearly, We're not through. Like nobody is sounding the all clear in financials. That's why they hit their lows today. No one is sounding the all clear in terms of ultimately energy. That's not my intent. My intent, okay, of picking right now on tech is to say the marketplace is going to correlate. Okay. And you're going to start to actually see, instead of like, financials going down and energy going down and tech going up, they're going to correlate. They're going to start to actually trade with cohesion. Everything is going to move as one. And that's when you're going to know there's going to be some phenomenal short entries on tech. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.